how I beat the S&P 500 over the last 12 months, and 2 tactics fund managers use to beat the S&P 500. That's what we're going to be talking about in today's video. I am not a financial advisor. This video is for entertainment purposes only. Learn to invest like a wolf at your own risk. What's up, everyone? Welcome back to my channel, Wolves of Investing. My name is Donnie Nguyen and I'm the founder of Wolves of Investing. If you're new, my channel is primarily about investing in the stock market. If you want to learn how to achieve financial freedom through investing, be sure to click on that subscribe button and notification bell if you haven't yet. In today's video, I'm going to be giving my final monthly M1 Finance portfolio update for my Investing on a Budget portfolio. I've had this portfolio for 1 year and I managed to beat the S&P 500 by 17 percentage points. I started this series to show beginning investors that it doesn't take a lot of money to start investing. It is so important to start early and build up those good investment habits, even with as little as $10 to $20 a week. Even though I'm not going to be giving monthly updates on YouTube anymore, I'm still going to be giving monthly updates at wolvesofinvesting.com. So in today's video, we're going to do the portfolio update. We're going to talk about 2 ways fund managers use to beat the market. And then I'm going to talk about how I specifically beat the S&P 500 by 17 percentage points over the last 12 months. So without further ado, let's dive right in. What's up, everyone? So here's my M1 Finance portfolio. My all-time money-weighted return is 84.01%. I opened the account starting on August 23rd, 2019. My 1-year return is 83.18%. Quarterly return is 19.86%. And the last thing I want to look at is the 1-month return, which is 5.6%. Let's go take a look at the holdings. I currently have 13 positions. Cost basis was $1,321.39. The portfolio value is $1,754.79, for an unrealized gain of $433.40, or a cumulative return of 32.80%. If we take a look at the activity, all I'm doing is investing $50 every 2 weeks and dollar cost averaging into the portfolio. Starting next month, I do plan to boost this up to $60 every 2 weeks. I've had the portfolio for over a year, so just like I would if I were getting a raise in my job, I'm increasing the amount of money that I'm investing into the portfolio. A few changes you may have noticed that I made to the portfolio. I just added Roku and Square stock to the portfolio. These are 2 companies that I own in my bigger portfolios, and I've owned them for a few years now. They've done really well for me, and I finally decided to add them to this portfolio. I've been very bullish on Roku and Square for the last few years, and I continue to be bullish. I put a 12% target on both Roku and Square. Normally, I don't invest more than 10% principal into any individual stock, but I decided I want to experiment a little bit with 12%. So for Beyond Meat, Roku, and Square, those are my favorite investment ideas. So I decided I'm going to concentrate my portfolio into these 3 stocks, 12% weighting on each of them. The only other big change I made was to Moody's and Paycom. I decreased the target on both of those companies to 1%. I still like both of these companies. I just don't want to invest a lot of money into them at their particular price points. So Moody's is trading at $284.22, and Paycom is trading at $284.43. I'm going to try to wait for a better opportunity before investing more money into these 2 companies. So the next thing I wanted to talk about was 2 ways fund managers use to try and beat the S&P 500. And then I'm going to talk about how I managed to beat the S&P 500 in my portfolio. All right, so the first way that a fund manager can try to use to beat the S&P 500 is a very simple strategy. Basically, they would put 95% of their funds into the S&P 500 and then put the other 5% into a high risk but potentially high reward investment. By doing this, if they are wrong on that last 5%, they won't lose that much money since 95% of it is in the S&P 500. But if their investment thesis is correct and that 5% does really well, they can potentially beat the S&P 500 by a few or even several percentage points, and they can tell their customers, hey, look, we beat the S&P 500. So here's what that might look like on M1 Finance. So I created this pie, which is 95% invested in the Vanguard S&P 500 ETF and 5% in Tesla. Let's take a look at how that might have done over the past year. All right, so according to the M1 Finance calculation, this portfolio would have been up 53.1% over the last 12 months. And let's compare that with just the S&P 500. So over the same period, an investment in just the S&P 500 would have only yielded 16.14%. So by just putting 5% of the portfolio into Tesla, that particular portfolio had super gains. So we can play around with this. Let's say instead of Tesla, we did the S&P and Coca-Cola. So this portfolio, 95% into the S&P 500 and 5% into Coca-Cola, would have only returned 14.70%. Now let's take a look to see if we would have put it into a stock that performed really poorly. So let's try Aurora Cannabis. So a portfolio of the S&P 500 and Aurora Cannabis, even though Aurora Cannabis had a negative 86.57 return over the previous 12 months, the portfolio would have still made 11%. The second way that fund managers can try to beat the S&P is by just investing in their normal strategy and monitoring their performance versus the S&P 500 throughout the year. If at any time their portfolio is beating the S&P 500 by say 10%, then they can just pretty much take all of their risk off and invest in the S&P 500 for the rest of the year. For example, maybe in October or November, their fund is beating the S&P 500 by 2 or 3 percentage points. If that's the case, they can try to rotate all their investments into the S&P 500 and virtually guarantee that their fund will have beaten the market. So I don't use either of those strategies, just thought it'd be kind of fun to talk about them here. Now I want to talk about how did I manage to beat the S&P 500 in this portfolio over the past 12 months. So to compare apples to apples, I'm comparing my portfolio's performance of 32.80% over the last 12 months. I went over to Yahoo Finance and downloaded the last 12 months price performance of the Vanguard S&P 500 ETF. From there, I calculated what my returns would have been had I dollar cost average into the Vanguard ETF and had I increased my investments during the bear market like I did for my M1 Finance account. And I came up with a return of 15% had I just invested into the S&P 500. So the first reason I managed to beat the market over the past 12 months is luck. There is a huge factor of luck involved with beating the S&P 500. It's hard to quantify. Now, is it 10% luck? Is it 30% luck? Is it 50-50? Is it just a flip of a coin? It's hard to say. I don't believe in the random walk theory where, hey, you can just give a monkey some darts to throw at a dartboard and they would do just as good as any fund manager. I don't believe in that. If that were true, you wouldn't have Warren Buffett beating the market for decades at a time. You wouldn't have Peter Lynch beating the market 13 years in a row. But definitely there is a factor of luck involved. But there were a few things within my control that I did that allowed me to beat the market. The biggest thing that happened was coronavirus. Coronavirus caused the markets to drop 30%, and during that period of time, I increased my investments. I just plowed more money into my portfolio while the market was down. And as we know, the markets happen to have recovered from those lows. So that's one reason that I managed to beat the market in this portfolio. Another thing that I did, and if you watch my previous videos, I used to own Xilinx in this portfolio. And I had been on the fence about whether or not I should get rid of that investment. I finally decided to sell my investment in Xilinx and replace it with Nvidia a couple months ago. And I just happened to get into Nvidia right before it had a 32% increase. So again, definitely a lot of luck involved there. My investment in Nvidia and in all these companies I'm not looking at how they're going to do in the next month or two or in the next year. I'm looking at how they're going to do in the next 5 to 10 years. I'm looking at these companies growing my portfolio for the long run. I just happened to get into it right before it pumped 32%. And the last thing that I managed to do to beat the S&P 500 was just to invest in companies that I know, companies that I understand, companies that I think have huge growth potential, that I think are going to be making a lot more money 10 years down the road than they are today, and that are reasonably valued. By doing that, I increased my chances of beating the market. Now, that strategy is actually a long-term strategy. Again, there's a lot of luck involved with this particular strategy beating the market in this particular year. Whether or not I beat the market in this particular year, I would still be following this strategy because my goal for this portfolio is to make the most amount of money that I can from it over the next 5 years, 10 years, 15 years, 20 years. And I believe that this strategy is the way to do it. So tell me what you think. Drop me a line in the comment box. Be sure to leave a like on this video before leaving. Thank you so much for watching, and I'll see you next time.